Unlucky market timing won't destroy your portfolio. Even if you invest at the worst possible time, you still beat cash. And in this study, we're talking about investing right at the peak, the worst possible time before the 7 most recent crashes over the last 29 years. This is the first costly mistake: waiting to invest. Or put another way, trying to time the market. You've heard it before. I've been there myself. In my case, it was delaying investing more money during 2020 when the market crashed, the market had to keep falling, right? It made sense to me with everything going on. Well, after one of the sharpest crashes in history, the market bounced back quicker than it ever had before. Many people are constantly waiting for a dip, waiting for a crash, waiting for the right time, waiting for more certainty. But unfortunately, investing doesn't work like this. The solution: if you're investing for 10 plus years, just get the money invested ASAP. Don't try and time the market. It's impossible. And you need to be right twice: when you sell and when you buy back in. Don't keep excess cash on the side waiting for a crash or for the market to just fall a little more. You've been there probably. I know I have, because it might never come. And even if you get really unlucky and invest the day before a big crash, well, the market has bounced back 100% of the time from every previous crash. If you're new here, I'm Ryan, a chartered accountant. I built my own portfolio to 6 figures since 2017. In this video, I'm going to be sharing with you 6 costly investing mistakes that UK investors make, and more importantly, how to either avoid them or fix them. One of the easiest ways to avoid a lot of these mistakes: use the right investing platform. And to avoid this first one about market timing in particular, set up an automatic monthly investment. And this is exactly where Trading 212 comes in. You can automate your investing so money goes in every month without thinking about it, using their auto invest feature. That way you're investing every single month regardless of what the market is doing, which in my opinion is the best way to build long-term wealth. You can get a free fractional share of up to £100 by downloading the app and using the promo code MMS, or scan the QR code on screen. For full transparency, this is an affiliate link. A massive thank you to anyone who decides to use it, and a big thanks to Trading 212 for sponsoring this video. An easy one to make when you first start out investing: overcomplicating your portfolio. This can take many forms. When I review portfolios, I often see portfolios with 10 different ETFs, random stocks, in recent times more gold and silver, ETCs, a bit of everything all thrown together. And it usually comes with this: chasing performance, buying whatever is hot and what everyone's talking about, checking your portfolio too often, investing based on tips you see in forums and on TikTok, constantly tinkering, chopping and changing your investing approach. This isn't a strategy, it's emotional decision making. It's overcomplicating things and will probably leave you much worse off. The solution: 1, understanding that complexity is your enemy when it comes to investing. 2, have an investing plan and stick to it. Keep 80% of your money going to your core portfolio, something like a low-cost global ETF or a few different low-cost ETFs. This applies to many facets of life. KISS, keep it simple, stupid. One I see almost every week: overlapping ETFs or diversification. For example, a global FTSE All-World ETF like VWRP already has around 60% in US stocks. If you then add an S&P 500 ETF like VUAG on top, which is 100% US stocks, you end up with roughly 80% of your money being invested in the US. If you then add a NASDAQ ETF on top too, say EQQQ, which is 95% US, now you have 85% of your money in US stocks, whether you realized it or not. That's not diversification, that's concentration. Less diversification without realizing it, and it increases your risk without you realizing. Most of your money is concentrated in a small number of stocks, and unfortunately many people only realize that when it's too late. Always check what's actually inside your funds. You can do this inside Trading 212. Go into a fund, scroll to the bottom, and then see fund details. If you do have overlapping ETFs, just make sure it's intentional. Although I speak from personal experience when I say that more funds doesn't necessarily mean better returns. It usually means more concentration, more confusion, and more temptation to tinker with things. All things, of course, as we've said, you want to avoid as a long-term UK investor. This one is painful because it's completely avoidable: not investing through an ISA, and it's often done accidentally I did it myself. When I first started investing, I accidentally used a general investment account as I didn't know what a stocks and shares ISA was. But often by default, you open up a general investment account when signing up for an investment platform. By using a GIA, you could be paying tax that you could have completely avoided. Capital gains tax, dividends tax, income tax. That's money straight to HMRC for no reason that you could have not paid. So whatever platform you're using, just make sure you're using your ISA first. When this comes to trading 2-on-2, for example, use their stocks ISA account first rather than their invest account. You get a £20,000 ISA allowance every year at the time of recording. Anything inside it grows tax-free. Use that first and save yourself a huge future tax headache. Now onto a big one, choosing the wrong platform, as well as not understanding all the fees you're paying. Fees are one of the few things in our control as long-term investors, but they're one of the biggest wealth killers, and most people don't even realize they're paying them. If you are investing in funds like ETFs, then fund fees will always apply regardless of what platform you're using. But there are some fees that are platform specific. For example, platform fees to use the platform, trading fees when buying and selling. The low hanging fruit here, use a zero fee platform, then you can completely avoid both of those fees. But the part that goes much more unnoticed, as you don't always take account fully of these, as some of them can be small and indirect, is these fees on screen. It's platform specific, of course, again, but some will charge for these. And over time, they can quietly eat into your money, especially if you're buying and selling often. So the bottom line, make sure you actually understand what fees you're paying when it comes to investing. The easiest way to avoid most fees, use a zero commission broker. A lot of people invest in ETFs, as they should. I do myself. The best way to invest for most people, myself included. But many people end up picking the wrong ETF as they don't understand the ETF they're investing into. These are the main two things to check. Number one, the dividend policy. Accumulation means dividends are automatically reinvested. Distribution or income means dividends are paid out as cash into your investing account. Pick the one that suits you. If you're not sure, accumulation is usually the better option, as it will auto reinvest the dividends back into the fund and compound your wealth quicker. Secondly, currency. Some ETFs, confusingly, can be listed in multiple currencies. A classic example is VWCE and VWRP. One is listed in euros and one is listed in pounds, although they track the same underlying index. But some ETFs are also just not listed in pounds or GBP, full stop. One popular example is the IMID ETF, a great ETF, very diversified, but unfortunately, there's no GBP option right now, only USD or Euro. Now, this doesn't actually change the underlying investments, but it can affect your FX fees when buying. So if you want to avoid these FX fees, use a GBP denominated ETF. Bottom line here, double check each of your investments and make sure the actual investments are the ones you want to make. For most, this will be a GBP denominated accumulation fund. I've held my hands up. I made a lot of these mistakes early on in my investing career. But if you can, try to avoid these ones, keep things simple and automate where you can. If you do want to get around these mistakes and pay very low fees, I put the Trading 2-on-2 sign up link QR code back on screen. As a reminder, you can get a free fractional share of up to £100 using promo code MMS when you sign up. Thanks for watching. I really appreciate it. And if you want to discover 9 ISA secrets, and I bet you don't know at least a couple of them, watch this video on screen next.